We have seen the rise of EV, AI, then the Magnificent Seven, and now we are talking about the Fab Four. Hey everyone, I'm Jiun from Dxpert. You know how trends in our field keep changing? The Fab Four has been driving nearly half of the US 500 first quarter gains in 2024. Other companies within the US 500 index are also starting to see signs of improvement or progress. Seems like the Magnificent Seven aren't so magnificent anymore. The Magnificent Seven seems to be losing steam, although the stock market overall is still up by 5.6% year to date. In some of our recent episodes last month, my colleague Jiun and I discussed the risks associated with the semiconductor sector, as well as the risks with Tesla and Apple. And it looked like our research was on point given the recent significant throwback in the market, especially the sharp decline in the share price of semiconductor companies like Nvidia, AMD, and SMCI. Apple and Tesla haven't shown any signs of bouncing back yet, especially with Tesla deteriorating fundamentals. On the other hand, Meta, Amazon, Alphabet, and Microsoft have remained stable, with their AI software and servers gaining traction, such as Meta Llama 3, Google Gemini, and OpenAI. Meanwhile, Nvidia has overtaken Tesla as the most popular stock among individual investors. It currently holds the largest average position in individual investors' portfolio at around 9%, according to Wanda Track data. Microsoft, on the other hand, snagged the title of the biggest US company from Apple, boasting a valuation that soared past $3 trillion. For Amazon, they have seen a significant uptick in profitability. As the year progresses, investors anticipate to shift away from big tech stocks and move into other sectors. This shift is largely driven by the expectations that the earnings of the remaining 493 companies in the index will outperform those of the Magnificent Seven in the fourth quarter. One reason behind the potential decline in the Magnificent Seven earnings dominance is the challenge of surpassing the remarkable growth they achieved at the end of last year. Those results seem like incredible successes compared to the weaker numbers of 2022. In the past, any signs of weakness in the Magnificent Seven would have caused a significant downturn in the broader market. In fact, for much of last year, these 7 stocks were responsible for all the US 500 advancement. However, this year represents a different scenario. Tesla is facing challenges on multiple fronts, especially stiff competition from Chinese counterparts, who have significantly increased their international presence in recent years. In their latest earnings reports, they revealed that their affordable electric vehicle options is back on the menu. Also, Tesla has cautioned about significantly slower growth in 2024, and its profit margin have suffered. Apple is also facing mounting troubles. The Justice Department recently filed a lawsuit against the company, accusing it of monopolistic behavior. European authorities are also increasing scrutiny on its App Store practices. The earnings growth of other firms within the US 500 is projected to increase over the course of the year, while the earnings growth of the Magnificent Seven is anticipated to slow down. So, what does this mean? It indicates a healthier market breadth, moving away from relying solely on a few mega-cap companies. Other companies are expected to join in on the growth, potentially including those in the US 2000 index. As we can see from the charts, the US 500 and US 2000 indices have generally moved together. But since the debut of OpenAI ChatGPT in March 2023, the surge in the Magnificent Seven has been notable, obviously due to AI. The gap between US 500 and US 2000 has remained wide and has widened even further recently. This broader market breadth trend isn't limited to just the US 500. The technology sector in the US 2000 is particularly noteworthy, sitting at 4.9 standard deviations above the pre-pandemic 5-year average, making it the most expensive. This surge is partly attributed to the rise of companies like Supermicro Computers or SMCI and MicroStrategy with the ticker MSTR to the top of the US 2000. In March, nearly every sector of the US 2000 experienced gains, with cyclicals surpassing tech as the index surged to a 2-year high. Energy led the gains, up 9.5%, followed by materials 6.3%, utilities 5.8%, industrial 4.7%, and tech 4.2%. Now, while things may start to look rosy, US 2000 may face a ceiling around its March peak unless economy experience a acceleration without prompting intervention from the Fed to curb resurging inflation. In Bloomberg Intelligence base case scenario, the fair value of the small cap index is estimated at 1.38 times sales. Assuming certain conditions like an uninverted yield curve, stable high-yield options adjusted spreads, and above-average revenue growth from the second quarter of 2025 to the second quarter of 2026, along with the Fed trimming its balance sheet as expected. On the other hand, small-cap value stocks at the moment still struggle compared to the growth counterparts, leading to multiple reaching extreme levels. Value stocks are currently trading at 1x forward sales, a 47.8% discount to growth stocks, well below the average discount seen since 2009. The price-to-book discount of 69.9% is also below the average since 2010. Although there are indications of bargain hunting in the market, the pace at which market breadth is spreading may require additional catalysts to accelerate further. Thanks for joining me today. I hope you have gained insights from today's video. Everything I've shared are information that I've picked up and sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risk. If you find this video helpful for your research, please subscribe, share, and like it. Quickly access to all our channels by scanning the QR code. Take care, and I'll see you in the next episode.